for exchange rates and forex. It is exchange rates and forex. So whenever we talk about the foreign exchange in India, it is basically managed under the FEMA, that is the Foreign Exchange Management Act, and under the FEMA, Reserve Bank of India is authorized so as to maintain the forex position, so whatever the rules and guidelines are over there which are being directed by the Reserve Bank of India are under the FEMA Act. So because the FEMA has empowered the Reserve Bank of India so as to issue the guidelines. Okay, so FEMA as it is, that is Foreign Exchange Management Act 1999, defines the foreign exchange. Now what is foreign exchange? So when we say foreign exchange, that we want to convert one currency to another, so whether we are converting Indian currency to foreign currency or foreign currency into Indian currency, that is basically the foreign exchange. That is a simple definition that you need to understand. So foreign exchange means foreign currency which includes all the deposits, all the credits, all the balances which are payable in foreign currency, or any of the draft or traveler check or any of the letter of credit, bill of exchange which are expressed or drawn in Indian currency and is payable in foreign currency. So whatever materialistic things, that whatever the instruments that you have expressed in Indian currency but are payable in foreign currency are basically related to foreign exchange. And vice versa is also true, that if any of the corporations, any of the institutions outside India have drawn any of the bill of exchange, any of the traveler check, any of the drafts related to it in foreign currency, and those are payable in Indian currency, that is also related to the foreign exchange. So that is the second leg of it. Okay, so the first leg is related to that all the balances which are expressed in Indian currency but are payable in foreign currency are part of foreign exchange, and also whatever instruments have been drawn, have been expressed by the corporation institutions which are outside India and but are payable in Indian currency, those are also basically related to what? Those are also related to foreign exchange. Okay, that is a simple definition related to foreign exchange. Now foreign exchange is not a small market. It is not like it is basically based upon some territory or some geographical area. It is a worldwide global market, and it is very much dynamic. Each and every second, each and every minute, the rates are being changed, and it is 24-hour working market. Okay, so the foreign exchange market works in different time zones. Like if it is 7:14 right now, it is 7:14 p.m. right now in Chicago or in Barcelona, there will be some different time zone. So if we have ended up our working day, it might be the case that they have just started their working over there. Okay, it might be the case. Okay, so foreign exchange, जो foreign exchange market है, that works in global market, that works globally. And further, in other sense, foreign exchange transaction is what? If we look at the definition, what is it? It is basically related to whatever contract it is. We are basically related to exchange of one currency with another. We are basically related to exchange of one currency with another. Exchange rate denotes to what? That at what price another currency is available. If I say 1 USD is equal to 76.48 INR. So it is basically what? It is a exchange rate. We can say simply, or we can write it as a ratio. We can write it as USD by INR. USD by INR is equal to 76.48. Okay, so that is in the form of ratio. Okay, we can simply say that exchange rates denote the price or the ratio or the value at which one currency can be exchanged with the another currency. Is it clear? Okay. After that, it is related to that I have already told you that the exchange rates are very much dynamic. It's not like that they will be static. They will be changing. They are varying basically every day to day, from minute to minute, from even second to second. And there is a huge lot market related to the spot rate. So we will be covering it right away, related to what are the different type of rate mechanisms over there. One rate is very, very much important and very much common. Over there, the whole lot of transactions just take place. That is the spot rate. SPOT, spot rate. Okay. Now let us have a look at the foreign exchange market. As I already told you, there is a large spectrum of the foreign exchange market, and it's not like that only individuals are working under this particular umbrella. All the individuals, business entities, commercial, investment banks, central banks, cross-border investors, arbitrageurs, speculators, each and every person who is basically dealing with the foreign exchange is being covered under this particular spectrum of foreign exchange. Okay. Now, it is a communication system based market. It is what? It is communication system based market. There is no boundary, no territories, and it operates round the clock within a country or between the country. So it's not like that only countries are doing foreign exchange. Even in between the country, there is foreign exchange. Like if we say person is here in Punjab and he wants to import some machinery from USA. He wants to import some machinery from USA. In that case, he wants to remit money for that particular purpose because he needs to pay the exporter. He needs to pay the exporter, and he is in need to pay USD 10,000. He is in need to pay USD 10,000. Now, in that particular case, it's not possible that USD will be available right away in the market itself. He needs to visit authorized dealer. He needs to visit authorized dealer, that is a bank, and further he will be asking for the rate. He will be asking for the price at which 1 USD is available, at which bank is ready to sell, at which bank is ready to sell. And that particular rate where the one rate is quoted by the bank and the other person is a customer, that is basically merchant rate. That is basically what? That is merchant rate. So there are basically two types of rate. One, it is an interbank rate when banks are dealing with each other. So when banks are dealing with each other, that is the interbank market rate, and the other one, it is a merchant rate when one entity is the bank and the other one is the customer itself. Okay, so the concept behind this is, so the purpose for this particular was, so when we will be solving the numerical it will be very much confusing part over there if you will not be learning the concepts, if you will not be concentrating on the basics. Okay, so one basic that we need to learn from over here, that there are two types of rate. One, it is a merchant rate, and the other one, it is a interbank market rate. So whenever the banks are dealing with each other, it is a interbank market rate, or whenever it is nothing is mentioned in the question itself that a customer wants to purchase, a customer wants to remit, we will take it as interbank market rate. But when specifically it is mentioned over there, we will take it as merchant rate. Now what is the difference over there? I'll just clear you when we will be discussing some numerical. Okay, so the markets are in different time zones. The Indian, Middle East markets are ready to start the day before close of Singapore and Hong Kong markets, as I already discussed with you. Then main participants are central banks, commercial banks, investment banks, and foreign banks, forex brokers, corporations, and individuals. These are all participants of the foreign exchange market. Now, factors determining exchange rates. Now, you must be curious about why these prices are being changed. Why foreign currencies prices are being changed or being altering for second to second, from minute to minute. Why the changes are there? It is basically due to a lot of factors, but there are two particular reasons basically related to it. One are the fundamental reasons, and other is a technical reasons. We will be covering all of them. So first of all, let us have a look at the fundamental reasons. So fundamental reasons, basically it includes all those causes or events basically which are concerned with the government. First of all, it is related to BOP, that is balance of payment. Very, very important term. It can be asked in the theoretical questions also. Okay, so balance of payment, what it is. So generally a surplus leads to a stronger currency and a deficit weakens the currency. But first of all, we need to understand what is balance of payment. So first of all, it is a statement. It is a statement of all the monetary transactions made between the resident of a country with the outside of the world. So what would be the net result? That is would be basically balance of payment. Like if we say that we are having Indian residents over here, and rest of world is basically denoted by this graphically by this big circle. Okay, now if Indian residents are to big transactions, they will be paying some amount, they will be receiving. So they will be paying foreign currency, they will be receiving foreign currency. That would be it. So this is basically the BOP is record of all the monetary transactions between the Indian residents, of the country and rest of the world during some given period. So BOP statement is for some particular period. If we say we are preparing BOP for 1 year, we will be covering all the transactions of the residents of a country with the whole world. Okay. So the statement includes all the transactions made by or made to the individuals, corporates, governments, and helps in monitoring the flow of funds to develop the economy. Now, one country need to have the foreign funds. One country need to have the foreign funds. So if a country is in a strong position and has the foreign exchange reserves, then it is said to be that their currency is strong enough. Then it can be said, we can just infer from here that our currency, our home currency is strong enough if we are having large foreign currency reserves. Okay, so BOP states what? It states the transactions. It states the transactions. It states all the records of the transactions between the residents of a country with the rest of the world. And further, it is said over here that if you are having a surplus, that the payments so made in foreign currency are lesser than that of the receipt, that receipt part is greater than that of the payment, in that case we will be seeing that BOP is a positive. So if it is a surplus, that will lead to a stronger currency. As I already told you, in that case your home currency will be stronger enough. And if you are having a deficit, that the payments are greater, if you have made the payments are greater, the transactions in payments are greater than that of the receipts, in that case the currency would be weaker. Okay, so that is basically the first point, that is the BOP. Second, it says it is related to the economic growth rate. So if you are having a high growth rate, that basically leads to what? That leads to that you are going to import in huge amounts. That is, there will be a rise in imports. In that case, there will be rise in imports. So if there is high growth, like if there is infrastructure growth, if there is economical growth, if there is new factories are being set up, new manufacturing hubs are being set up, in that case your needs are rising. And so as to cope up with those needs, you need to import more. And whenever you import more, in that case you need to pay foreign currency more. In that case you need to pay in foreign currency in more amounts. Okay, that will be basically doing what? That will be weakening your currency. That the value of the currency will be falling. Okay, and further, it is fiscal policy. It is related to fiscal policy. So if you're having an expansionary policy, that let us say that the government lowered the tax rates. So let's say above 10 lakhs the tax slab is 30%. Let us say government lowered it to 10%, which will be true in dreams itself, but let us assume it, because we just need to take it as it is an assumption. Okay, so we assume that the tax rate was earlier 30%, but now it is a 10%. In that case, residents will be having more money in their hands. More money will be led to more expenses. It will lead to more expenses, that is higher economic growth. And if there is higher economic growth, it will lead to a rise in import. Rise in imports will lead to fall in the value of the foreign currency. Okay, so did you understand the criteria, what it is? So whenever there is fiscal policy is expansionary, if the fiscal policy is an expansionary, that government wants people with more money in their hand, more money in their pocket. In that case, what will happen? Residents will be having more money in their hands. That is more purchasing power. More purchasing power means more economic growth. More economic growth will lead to what? It will lead to more imports, and that will lead to fall in the value of the foreign currency. Okay. Next, it is a monetary policy. Now, monetary policy is also having impact on the value of the currency. How it is possible? Let us say under the monetary policy, different ratios, SLR, CRR are being maintained, and let us say government lowered the SLR. Previously it was 24%, and government lowered it to 16%. Let us say now the government lowered the SLR with the SLR to 16%. So SLR is the amount, that is a statutory liquidity ratio that the banks need to maintain as a part of their net demand time liabilities with the Reserve Bank of India in the form of cash, gold, or unencumbered approved securities. Okay, now if the banks were maintaining that particular part with the Reserve Bank of India, in that case they were short of amounts that they can lend. If the SLR is 24%, that means out of 100 rupees only and only 76 rupees can be lent. Out of 100 rupees, only and only 76 rupees can be lent. But if SLR is lowered to 16%, it means what? It means now the banks are having additional 8 rupees to lend out of it. Now, if the lending is more, in that case, people will be having more money, and that will lead to the same criteria that we have learned over here in the above fiscal policy. It means the people will be having more money with them, they will be having more purchasing, there will be higher economic growth, and that will lead to the devaluation of the currency or fall in the value of the currency. Okay, after that it is interest rates. So higher domestic interest rates, higher domestic interest rate will tend to attract overseas capital. Now let me give an example. Let us say in India itself, the interest rate is 11%. Let us say the interest rate is 11% in India, and in USA the interest rate is 3%. Now the persons who are having extra money in their hand and they want to invest their money abroad, they will be doing what? They will be selling USDs. And they will be purchasing INR. So as to invest in the Indian market. Which is having higher interest rate. So there will be flow of USDs to India. And ultimately it will lead to what? It will appreciate your currency. But in longer run, this is for shorter run only. But in longer term, what will happen if there are higher interest rates? The economy will slow down. Because people will be having lesser money in their hands. Because more of the money will be invested in the market itself, and people will be having lesser money, and ultimately it will lead to economy slowdown. Okay, that is weakening the currency itself. Then it is a political issues. So many political issues, sometimes due to the political issue itself, it leads to economically instability. So the currency is not having there is not a steady currency if there are political issues. If there is political instability, in that case it will lead to economical instability. And ultimately the foreign exchange rates will be volatile, and no one would be in a position so as to invest in your country. So if our political system is not stable, let us say if our political system is not stable, in that case the foreign companies will not be willing so as to invest in the country. Okay, so it is also having an impact. After that, the second leg of it is the technical reasons. It is related to the technical reasons. So government controls can lead to an unrealistic value of currency. If government controls the currency, so previously the Forex was controlled by the Reserve Bank of India. The prices were fixed by the Reserve Bank of India. But now the prices of foreign currency are market driven. It is purely based upon the demand and supply. And the other market forces we are having. Okay, so if the government controls the prices, in that case it can lead to unrealistic value of the currency, which can lead to violent exchange rates. Because when you will be shifting to the abroad market, the market will not be led by the government itself. In that case there will be different prices, so there will be violent exchange rates. So first of all, the technical reason is a freedom or restriction on capital. That movement can also affect the exchange rates to a larger extent. So if your government is reluctant and they do not want their reserves to be emptied, if they do not want that, they want to procure more foreign currency, in that case that will lead to what? In that case your foreign exchange rates will be violent and your currency will be weakening internationally. And let me give an example with it. So in the case of Indonesia, Korea, which were having huge surpluses due to higher demand of the petroleum products, and ultimately they were having higher reserves. They were having the higher foreign currency reserves. So because these countries are exporting petroleum products, and there is high demand of petroleum products, and ultimately they ended up with huge foreign currency reserves. But now they are having these vacant foreign currency reserves. They do not have any domestic they do not have any domestic facilities so as to invest this foreign currency. So what actually happened, they were having higher foreign currency reserves which were useless, which were futile, and ultimately they invested this foreign currency in other countries. They invested this foreign currency in other countries, which ultimately led to what? Which ultimately led to appreciation of the currency of that particular country. Let us say they invested in India. In that case, Indian rupee will appreciate. So restriction and freedom both lead to the exchange rate deviations. Okay. After that, it is related to speculation. Now, speculation is what? That which is given an idea that the currency price will go up or it will go down. So it is just an expectation. It is just an expectation that the currency may be devalued or the currency may be having a higher value. So if the price of the USD was 76.10 and I just speculated, I just have an idea that the price will go up. Let us say I say the price will go up to 78 rupees. In that case, I'll be doing what? I'll be investing, I'll be buying at lower price and will be selling at higher price. And vice versa is also true. Let us say today the price is 78 rupees and I'm expecting that the prices will be lowered. In that case, I'll be selling the USDs at 78 and will be buying at lower price. That is called what? That is called short sell the currency. Where we sell the currency first and buy it later at a lower price. That is called short sell it. That is called short selling. Okay. So speculation is also a reason due to which there is dynamicity in the foreign exchange currency prices. Next, it is a exchange rate mechanism. So as I already told you, it's a global market. So it is not like that you have processed the transaction today and it will be settled today. So based upon the delivery of the foreign exchange, that is the settlement of the foreign exchange, the transactions can be classified, the different rates can be classified as ready rate or cash rate, term rate, spot rate, forward rate. We'll be discussing them. Okay. So settlement of funds take place on the same day in the case of ready or cash rate. That is on the date of deal. So if I made a deal, if I cracked a deal with person A, let us say person B cracked a deal with person A, and they basically the deal was made on 26th of September. And on the same day, the foreign currency was also settled. In that particular say, we will be saying it is a ready or cash transaction. Okay. So settlement of funds takes place on the same day. That is, if the date of ready or cash deal is 15th of October 2019 and settlement date is also the same day, we'll be saying it is a ready transaction or a ready deal or cash deal. Okay. Other one, it is a term rate. Term means the next day. In the case of a ready transaction, it is T+1. That is the date of transaction and the settlement date is the same day. So it is T+0. In case of ready, it is a T+0. Whereas in the case of term rate, it is T+1. In the case of a term transaction, it is T+1. That will be doing the transaction today, but it will be settled on the next working day in the both of the centers. Okay. Let us say that there was a deal in center A and center B, and the deal was made on 26th of September. And there was a transaction on 26th of September, but it settled on 27th of September, keeping in mind that both the days, 26th September and 27th September, are working in both the centers. In that case, we will be say it is a term rate. Let us say if 27th of September is not working in center B, 27th of September is non-working in center B, and the transaction settled on 28th of September. Settled on 28th of September, keeping in mind 27th was a holiday. In the center B. In that case also it is a term transaction. It is also, in that case, it is also basically what? It is a term rate. Okay. So in case of term rate, the settlement is on the next working day. Is on the next working day, that is, it is represented by T+1. And the next one, it is a spot rate. As I already discussed with you, that most of the transactions that are covered online, that are covered basically, are based upon the spot rate. So whether you are basically dealing with the forward rate, this is basically based upon what? This is basically based upon the spot rate. So in the case of spot rate, the settlement of the transaction is after 2 working days. So if you made the transaction today and the settlement is after 2 working days, then it is basically what? It is a spot rate that you are quoting. Okay. So the settlement of funds takes place on the 2nd working day, not after 2 working days. We'll be saying on 2nd working day, not after 2 working days. It is on the 2nd working day. That is basically what? That is a spot rate. That is basically the spot rate. Okay. So that is also very much necessary to know that all the days in between must be working days. These will be working days. Like we have taken an example also, if the date of the spot deal is 5th of October 2019 and the settlement was made on 7th of October 2019, we will say it is a spot rate, keeping in mind that 5, 6, 7 all are working days in both the centers. All are working days in both the centers. Okay. So as I already told you, that volume of the transactions, the depth of transactions, the volatility of the transaction in the spot market is higher because of the participation, because of the large participations of the market player. So whatever the large participation is there is more volatility in the market also. So in the case of spot rate, there is larger volatility and a larger volume. Okay. Then it is a forward rate. If the settlement is on any of the day beyond the spot rate, in that case, it is the forward rate is to be quoted. In that case, the forward rate is to be quoted. And in the case of forward rate, the forward points are added or subtracted from the spot rate. So what is the formula for spot rate, for the forward rate? So if we said first of all, relative to definition, if the settlement date is greater than that of the T+2, in that case the transaction is what? In that case the transaction is forward rate transaction. And in case of a forward rate, that is basically equal to spot rate plus minus premium or discount. So forward points would be added or subtracted, so as to get the forward rate. Okay. Then it is a forward margin. As I already told you, that in the case of a forward rate, if you need to calculate the forward rate, it is calculated based upon the spot rate. That is why there is huge volume related to the spot rate transactions, because it is also used in the forward rate. It is also used in quoting the forward rate. Okay. So in case of forward rate, the transaction, how we can calculate this particular rate, it is basically forward rate is equal to spot rate plus premium, or we subtract the discount. Now why the forward points are there is premium or why there is a discount? So when the currency, let us say the price for 1 USD today is available at 76.10 INR, that is for 76.10 INR I can purchase 1 USD. And let us say after 2-month period, that is after 2-month period, the price is speculated on higher side. Let us say after 2 months the USD is available at 76.40. In that particular case, I'll be saying that the currency is available at premium. Because there is some addition to the spot rate value. So I'll be saying there is an addition to the value, so it is available at premium. Okay. So currency is dearer than today itself, than the spot rate itself. Okay. So if the currency after 3 months, let us say it is available at price of 75.90 INR, that is lower than that of the spot rate. I'll be saying the currency is available at discount. and the points that we add to the spot rate or subtract from the spot rate, those are called forward points. Those are called forward points or forward margin. Okay, so if the value of the currency is more than that being quoted on the spot rate, that is basically what? Premium, that the currency is available at premium. And if it is lesser than that of the spot rate, we'll say the currency is available at discount. Okay, now let us have a look at the forward points, that why the forward points are there. These forward points are there due to the interest rate differential. Due to the interest rate differential. If we talk about some perfect market, that the demand and supply is basically only and only fixed by the interest rate differentials, that only and only different interest rate differences create the demand and supply. In that case, forward points are to be calculated by interest rate difference. Okay, so as I have already discussed an example with you, whereas in case of India the interest was 11% and in USD and in USA the interest was 3%. In that particular case, persons in USA, the investors in USA are going to sell USDs in the market and they will be buying INR and they will be investing in India. And let us say this 11% interest rate is available on an instrument particularly for a period of 3 months. It is available particularly for a period of 3 months. So the people in USA will be selling the USDs and they will be buying the INRs for a period of 3 months. So there will be availability of USDs in the market in huge. Okay, and after 3 months there will be demand of USD. Why there will be increasing in demand after 3 months? Because after the passage of 3 months, when the interest rates are not available at 11%, people in USA will be selling INR and they will be buying the USDs again. So there will be higher demand. There will be higher demand to buy the USDs after 3 months. So that basically creates a demand supply function, and that is how we calculate the forward points. Okay, so now what is the formula related to that we can calculate the forward points? Because it may also ask in the examination sometimes that how to calculate the forward points. So let us have a look at the formula. So the formula says forward points are equal to spot rate multiplied by the interest rate differentials into the forward period divided by the number of days in year into 100. So it is simple. So it depends upon 3 factors. One of it is the spot rate of the transactions. Other one it is the interest rate differentials. And the third one it is a forward period, for the period that we want to calculate the forward points. Okay, divided by number of days in year. For easier calculation, we will take it as 360 and multiplied by 100. That is basically we converted the interest rate differential into decimal part. Okay, this is a particular formula related to the forward points, that how we can calculate the forward points. So it basically depends upon 3 particular areas, that is the spot rate, interest rate differential, and the forward period. Okay, so if we are provided with some of the information and we need to calculate, can we do the calculation? Definitely we can calculate the forward points. So calculate the forward points or the swap cost, that at what particular point we will be able to swap one currency with the other. So basically that is related to what, that we can say it is a forward contract. So whatever rate mechanisms are used, these are basically contracts. So if we use a forward rate, we will say it as forward contract. Now what is a forward contract? Let us say if I want to purchase USDs after 3 months. In that case, I'll be in a contract with the party where one party is ready to sell after 3 months, and I want to buy. So it is basically what? It is an OTC. Now what is OTC? It is over the counter contract. That two parties are dealing with each other so as to satisfy their needs. So it is an over the counter contract. Where one party is buyer, other party is a seller, and they want to sell the USDs in the future, and the one party want to buy the USDs in the future. Okay, so as per the different criteria, as we have already discussed, that is based upon the spot rate, based upon the interest differentials, based upon the forward period, we will be calculating the forward points, and the rate would be quoted to us. So it is basically related to what? It is related to the forward contract. Okay, so the question was, calculate the forward points or the swap cost. Euro 1 is equal to USD 1.60. Interest rate differential is given to be 6%. Forward period is given to be 90 days. Okay, and it is clearly mentioned over here. Number of days to be taken in a year is 360. It is given over there. So what would be the forward points? So I have already told you the formula. So it is given to be 1 euro is given to be 1.60. So it is the spot rate first of all multiplied by the interest rate differential, which is given to be 6%. We will be write it as it is, multiplied by forward period, that is given to be 90, and divided by number of years, which we are to take it as 360, and we are to convert this particular percentage into decimal part, so divided by 100. So that would be how we will be calculating. This is how we will be calculating. So just let me know the answer at the earliest. So जल्दी से जल्दी आंसर बता दीजिए कि क्या आंसर यहाँ पर रहने वाला है, ताकि हम ये पता लगा सके कि हमारा जो आंसर है क्या वो सही है भी या नहीं है. So kindly do confirm the answer at the earliest. Okay, so यहाँ पर देखिएगा, it is 1.6 multiplied by 6 multiplied by 90 divided by 100 divided by 360. That is basically 0.024. That is basically 0.024. Those are the forward points. Those are the forward points after 3 month period. After 3 month period, these come out to be 0.024. Okay, so that is how we can calculate the forward points. Okay, now further, let us have a look at the direct and indirect cost. Now the important points you need to understand. These are all basics, but we need to understand so that we can learn the foreign exchange completely. Okay, so first of all, it says direct and indirect costs. Now what are direct cost? In case of direct cost, the home currency is variable. So when I gave you cost related to that 1 USD is equal to 76.10 INR, in that particular case you must have noticed that the 1 unit is fixed over here. But this particular part, that is a home currency, is variable. Now today it is 76.10. The next hour or next minute it will be somewhat else. Okay, so the home currency is variable and the foreign currency is kept constant. It is fixed unit. It is having a fixed unit. So that is why it is said to be the direct cost. So in the case of direct cost, if you want to make profit, the rule is buy low, sell high. So if 1 USD is available at 76.10 now, and if I sell it at 76.28, now I'll be in a win-win position. Because now I'm selling it at a higher price. So that is why it is said to be buy low, sell high for profit purposes. Okay, so the direct cost is one where the home currency is variable and the foreign currency is having a fixed unit. Okay, so in the case of direct costs, on the left hand side there will be only 1 unit, but on right hand side you will be having a variable unit. But only and only in the case of the Kenyan shilling, Japanese yen or Indonesian rupiah, in case of these three currencies, that is Japanese yen, Kenyan shilling and Indonesian rupiah, the quotation would be not for 1 unit, but it will be for 100 units as per the FEDI rules. So as per the FEDI rules, the direct cost for three currencies, that is the Japanese yen, Kenyan shilling and Indonesian rupiah, it will be for 100 units and not for the 1 unit. Okay, otherwise the price would be quoted only and only for 1 unit, like for euro, for GBP and all the other currencies, it will be for 1 unit only. Now let us take another case that is related to the indirect cost. Now what is the indirect cost? In case of indirect cost, the home currency is having a fixed unit value, whereas the foreign currency is variable. So let us say, if we say for for 100 INR, let us say 1.25 USDs are available. For 100 INR, 1.25 USDs are available. So this quote is what? This quote is indirect quote. This quote is indirect quote. And what if you want to make profits out of the indirect quote? What is the rule? Rule says buy high, sell low. Buy high, sell low. It means what? If we are able to purchase 1.25 USDs for 100 INR, if we are able to purchase 1.25 USDs for 100 INR, and moreover, we need to sell, if we say that for 100 INR itself, that is on another quote, that is on another one, it is basically available at, for 100 INR, we are getting 1.28 USDs. 1.28 USDs. Now we basically did what? We buy it high. We buy it high and sell it for low. In that case, we will be having the profits. In that case, we will be having the profits in the case of indirect quote. Is it clear? Okay. So for indirect quote, the rule is buy high, sell low. But for direct quote, it is buy low, sell high. Further, it is related to cross rates. Now, it may be the case that the rate, that the exchange rate for the different currency pairs is not available. It may be the case that the quote price is given for USD to INR. It is given for USD to Euro, but it is not available for INR to Euro. It is not available for Euro to INR. In that particular case, we can identify the rates using the cross rate. We can identify the rate using the quote rates. So wherever the rates for a particular currency pair are not directly available, wherever the rates for a particular currency are not directly available, we can discover the prices using the cross rate mechanism. We can obtain the prices directly, indirectly using the cross rate mechanism, and we'll be explaining it with an example. We will be explaining it with an example. Let us have a look at it. It is quite important to look at it because we'll be covering multiple concepts over here in this particular example. Okay, so let us have a look at it. So B wants to remit euro. B wants to remit euro. Now the first thing that must be striking to you, that is basically in that particular case, B is not a bank. B is not a bank, it's a customer. B is what? B is a customer who wants to remit euro. Let us suppose that he must have purchased a machinery from USA. He must have purchased a machinery from England. Let us say he has purchased a machinery from England and he wants to remit euro to England. He wants to remit euro to England. Okay. Now in that particular case, B must be purchasing the euros first of all. B must be purchasing the euros first of all. Now B will be able to purchase the euros at a price at which the bank is ready to sell. Very, very important point to know. Now first point that I covered, that B had purchased a machinery from England and he want to remit euro over there. In that case, if you want to remit euro, he needs to purchase euros. And as a customer, I'll be able to purchase euros at a price at which the bank is ready to sell. Okay, so that is the first point. That he needs to purchase the euros. Okay. Second, it is given that USD1 is given to be INR 76.10/25. It is given to be 76.10/25. So you are over here provided with the buy price and the selling price. You are provided with the buying quote and the selling quote. Okay. So the price given on the on the left hand side of the slash. The price given on the left hand side of the slash, it is a buying price, buying quote, and the price given on the right hand side of the slash, it is a selling quote. Okay, so the buying price is 76.10 at which the bank is ready to buy, and 76.25 is the price at which the bank is ready to sell. And the another price is also given, that is USD is equal to euro. It is given equal to euro 1.06. It is given to be 1.06. That 1 USD is available for 1.06. So it is given to be two-way quotation. It is basically what? It is two-way quotation where buying rate and selling rate both are mentioned in one quote only. Where both the rates are mentioned in one quote only. And we need to identify euro to INR. We need to identify euro to INR. So now the price which will be quoted by the bank to customer, which will be quoted by the bank to customer, it would be merchant rate. It would be merchant rate because merchant is asking the price, so that price is to be quoted. But in case banks are dealing with one another, that is basically related to what? It is basically related to interbank market. Interbank market. So you need to understand these basics. You need to understand these basics. So it is basically what? It is the interbank market where the bank will be having the prices. Okay. Now try to understand one thing. Now the customer went to the bank and he said that he wants to remit a euro, and the bank is not having euro rate as such. So there is no direct pair rate for the euro INR exchange prices. Euro INR exchange prices are not over there, and we need to obtain the same. We need to obtain the same. So first of all, what will be done? Bank is having INR reserves. Bank is having INR reserves. So the bank will be doing what? Bank will be buying USDs. Bank will be buying USDs first of all. So bank is to buy USD first of all. Okay. So the bank will be able to buy USDs at what rate? So bank is also acting as a customer for the other bank. Bank is also acting as a customer for the other bank over here, from where the bank will be buying the USD. From where the bank will be buying the USD. So bank will be able to buy the USD at what price? At the price at which the other bank is basically offering, at the price at which the other bank is ready to sell. Okay, so here it was the selling rate, it was the buying rate. So which of the price will be used? The selling quote will be used, because the bank will be able to buy. So this is bank 1 and this is bank 2. So bank 2 wants to sell USD and bank 1 wants to buy USD. So bank 1 will be able to buy the USDs at a price at which bank 2 is ready to sell, at which the bank 2 is offering to sell. So it is basically what? It is a selling quote which will be using. So it will be basically USD is equal to INR 76.25. 76.25. Okay. So that is a one quote we are having, and the other one, it is given to be USD euro quote is given over here, that is 1.06. Now we just need to make like we did in our academics, that LHS is equal to RHS. Just do the same, apply the same concept. So it is basically equal to INR 76.25 is equal to euro 1.06, and we need to identify euro to INR price now. So it will be 76.25 divided by 1.06 is equal to euro to INR price. So that is how we can calculate. So it will be 76.25 divided by 1.06. So it is 71.93. So it is 71.93, that is euro to INR price. Okay.